Hey, good morning, everyone. Marty Missouri here, Wednesday, June 8th, 2022, with your midweek market snapshot. As usual, we'll focus on the charts for the S&P 500. I want to talk a little bit about breadth as well and what we're seeing there, and then look at kind of where we are today in the context of how much, in terms of a drawdown, the market has given back from a time perspective, meaning how long ago was it that we first reached these levels right here? And just to give you a feel for what market action amid what we think we may be dealing with right now, and that's a mid-cycle slowdown in the economy, how that looks historically, how frustrating that can be, and just kind of help you put all that in perspective and keep you thinking long term about the dynamics around your long-term portfolio. So first things first, the 60-minute, 60-day chart of the S&P 500 that we've been working here for the last several months. Calling a short-term bottom right here was easy, particularly on this 60-minute chart. Notice that we had a downward wedge. We had bullish divergences on the momentum indicators, and we had a key Fibonacci retracement level here that we showed you on the weekly chart. And we had hugely negative sentiment going into that. So a lot of people were off sides, technically and from a sentiment standpoint, the stage was set for a nice rebound. And recall that while we explored the high possibility of this happening, we also set a upside price target of 4,300 on the S&P, which we've yet to reach. And as this begins to evolve, I would say the odds of that look to be lessening here, at least on the short-term chart, although that remains our base case. There's plenty of reason why we think that is achievable still to the upside, maybe even a little higher, but not sustainable in the grander scheme of things when we think about where we are with the current market setup and what probably needs to play out before it's over. So again, though, on the 60-minute chart, this is a lot less encouraging than it was here, because you see we have this just this inability to penetrate this level right here. We just keep bumping our heads against it, all the while the MACD and the RSI are rolling over. But there's a lot of factors in play. This morning, on the written blog, I really kind of got into the weeds in terms of what we're understanding about options positioning right here, and how folks who are exposed on the short side, the sellers of options, to folks like us who are hedging portfolios, those who sell us those options have got to hedge their positions, and that can exacerbate moves in one direction or the other and completely conflict, as I said in the written blog, with what you think you know about overall conditions right here. And of course, long-term fundamentals we're most concerned about, but for a variety of reasons, we need to be very cognizant of what's going on in the short term as well, and what's influencing that. That impacts to some degree how we manage our hedges, whether we put new money to work, and so on. The one-year daily chart, however, does remain on net constructive, more constructive than the 60-minute chart. We have our falling wedge, and we still have these bullish divergences intact. Right now, when we square, say, the 60-minute chart with the daily chart, it's somewhat ambiguous. Whereas, again, back in here, the charts lined up beautifully that said, look for some serious upside in the short term. When we get to the longer term charts, first the weekly, from just a pure price action standpoint, we've identified a pattern here that we can point to over the last 30 years that says that when things begin to move in this manner with these patterns, we should expect a test of the 200-week moving average. That would be, if this works out to be a bear flag, gets us about there right now with this current pattern if we do break out below. And overall, roughly 28-30% decline, peak to trough in the S&P 500, and that is barring a recession, as I continue to say. Lastly, on that monthly chart, I'll just show you the long-term 30-year chart here. There is nothing here that is encouraging. We have just the strongest of sell signals in the monthly MACD compared to the last 30 years. And when we've gotten these outside of recession, we've come down and tested the 50-month moving average, which is roughly the same as the 200-week moving average. And that gets us down to another, roughly the same, 16.5% from here to get to that place on the monthly chart. So the long-term technical setup, at least by this assessment that we've done right here, says at very high odds that the worst is yet to come, but that it's not necessarily devastating. And if we hedge well and mitigate a good chunk of that, we'll be in a really good position right here if nothing changes in our thesis between here and there. Okay, so this morning we have the S&P, flirting with the flat line. However, breadth is abysmal. When the S&P, I think, was slightly positive at one point or almost there, for every one stock that was rising, 3 were falling. Now, speaking of breadth, and I wanted to share something a little different with you today, and I'm actually pulling from our exhaustive weekly spreadsheet. You may recall that our last scoring of our what we call our equity market conditions index that we score once a month went from a very negative 0.58 to a still negative 0.8, but it improved notably. Breadth was very interesting to see. Now, I just mentioned how bad breadth is today, but some of the trends in the breadth readings are beginning to look somewhat encouraging. So recall, a few months back, when we were really aggressively pointing to this look right here. This is the NASDAQ Composite Index, right? As it was pushing its way aggressively into all-time highs, the breadth, the advanced decline line, advancers compared to decliners, was rolling over pretty hard. And we were pointing to this up in here and saying, folks, this is a really bad looking setup right here. And sure enough, we realized about, at one point, I think we were pushing close to a 30% decline, about 22% as of yesterday. So this pattern was quite telling in terms of what to expect. And then, of course, breadth just continued to careen lower. More recently, right here in recent weeks, notice that we have a lower low, if you look closely, on the NASDAQ Composite. But suddenly, advancers were starting to lead decliners, right? So if we go down here and zero in a little bit, you can see it more vividly. We actually have a falling wedge pattern, which could be viewed as bullish. From a breadth standpoint, this also was evidence that we may, finally break out of at least this short-term downtrend. So breadth looked encouraging there. Also on the S&P 500. Now, this was a very good indicator to us back here. During the last time we had what turned out to be a mid-cycle slowdown, we had just real flatness, 2 years of just nothing other than a 16% correction along the way for the S&P 500. Well, it was, it was well into 2016 before the market actually broke out to the upside. In fact, you could move this out a little bit. Right in here in March, though, the AD line broke out to the upside. So we had the same consolidation pattern, but suddenly the breadth began to look positive, and sure enough, that was an indicator that this malaise was over, and now we had better things to look forward to. Now, when we zero in on that, you can see that we have a lower low, short-term low on the S&P, but we have a flattening out on the AD line. Okay, it's not crazy bullish at this point, but from that perspective, it is encouraging. Now, when we look at the New York Stock Exchange Composite Index, we don't have that divergence. It still looks relatively bearish. When you look at the numbers of stocks that are trading below their 200-day moving averages, that's still kind of a negative breadth look, but we are beginning to see signs, which support our notion that we don't have to have a 60% drawdown in stocks this go around. We're open to that scenario. We're going to be very careful as we manage our money in that direction. But again, our base case continues to build and support the notion that we've got further to go, but maybe not, the kind of cataclysmic feel of a bear market that we had back in 2008. So in closing, let's just explore really where we are right now in terms of the level of the market and how far back we have to go to see, what essentially the market has given up. Here we are today on June 8th, and to follow this line back, it takes us all the way back to April, call it April 13th, 2021. So we are essentially a year and a couple months, call it 14 months of action has been pretty much swallowed up by this correction in stocks right now, nearly a bear market. At the bottom, we go back, nearly, a year and a half or so of declines, and that's kind of consistent with slowdowns in the economy, and then a market responding to that. You end up with some pretty frustrating, sideways action. And then when we look at the Nasdaq Composite, right here we are today, got to go back to September of 2020. So, in about another 2 or 3 months, if we're right here, that'll be 2 full years of nothing in terms of the price action, start to finish, for the Nasdaq Composite. Of course, lots of volatility. In the long-term scheme of things, that's not all that unusual, right? Here's a couple years. Here is almost 2 years, a year and 9 months, right? Here, you can go from here to all the way over to here, and there's another couple of years and so forth. So folks, that's how markets work. To do well long-term, you basically have to have extreme patience during times like these. Our job on you clients' behalf is to recognize when the risk is elevated and to mitigate as much of these downturns as we possibly can and be in a position to exploit them when our analysis says that the bottom is near, or that, I should say, the risk reward setup is supportive of being a little more aggressive. So folks, thank you for hanging in there, those of you who are still with me. We'll be back, of course, daily with our morning notes. And of course, at the end of the week, we'll give you our latest economic update. Friday could be big because we get the US CPI number. So that'll be interesting to see how the market responds to whatever that particular statistic delivers with regard to inflation. Take care, folks. Have a great rest of the day. Bye-bye.